Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host to the Market Buzz. So today I want to take some time and answer some questions I get through my email. So rather than jumping into an industry group or whatever today, this is kind of one of those use anytime videos for us to understand how to use different lines for support. And I got another email on it this week, so it's stuff like that we want to answer. And I think the best way to do that is put it in a video and then show all the different alternatives. So we're going to cover off line charts versus candlestick and bar charts, trend line, where to place them, log scale or arithmetic scale, adjusted for dividends or not, moving averages, Fibonacci, Keltner, horizontal support and resistance, and Chandelier Stops. So we've got lots to get to, so let me jump into it. Oh, and by the way, if you're interested, I also have a special going on for people who are interested in signing up with gregschnell.com. You can go to gregschnell.com/sports, and there's a special program there as we enter the playoffs in a couple of the sporting venues and start to kick off the sporting season in others. So with this, first of all, I want to cover off some line charts. And these are, what is a line chart? A line chart is this area in here. And the difference would be a bar chart would be shown like this. And each one is a little bar. So if we looked on the Zoom thumbnail, it would show up as little bars over here. Whereas on a line chart, it's just going to be a solid line, right? And then on a candlestick chart, if we went with that, then it would be candlesticks drawing that same in. So we're zoomed out so far. This goes all the way back to 1994. You can see the difference. But the point I wanted to make here was a couple of things. First of all, if you're drawing a line chart on a big long-term basis like this, you're not interested in each minute little penny. You're interested in the big picture and what is going on. And there's many different ways to draw this. You can see I have a horizontal line drawn in here. And the idea behind that horizontal line is to pick up what is really the main support and resistance area. You can get that by zooming out. Now, if I zoom in to, say, the last 10 years, it's going to show up quite differently. And then you can see, maybe my line is too high. Maybe I should have it down here. But this clearly stood out as a period where the market tried to get through and couldn't. And if you wanted it to be more of a support and resistance line rather than, say, just marking a big resistance line in here, maybe you use this one and you go down here to just pick a different area. Now, this was support all the way along, became resistance when it tried to bounce against it, then it came down, rallied up, and it immediately got through, kept using that for support, and then broke again. So it really depends on the purpose of the line that you want. Neither one are wrong or right. I think the big thing to just be aware of is a line is something to shoot against. It's a place where you think the market is telling you it's found support and it's going to continue to go higher until it doesn't. And at that point you want to sell. Or over here, at that point you want to sell. Or over here, you're seeing that this was kind of the support and resistance layer back when it topped out in 2011, 2012, and now you come up here, we make a new high and we pull back, and now we consolidate right around that prior high. Now we could pick a level, we could be much more exact, right? This was the absolute high in here. So we could use that, or we could use the lows in here and just say, okay, this was a support and resistance level in here. We found support there. Is that going to work? Or we can come all the way down to here. The purpose is to try and find a level that's important to you based on the timeline you want to trade. So again, there are no wrong answers. The biggest thing that you're trying to figure out is the market finding support. Now, it's not uncommon that when we got to this level here, when we tried to break out through this prior high, we got up, and then we got to this one, and we spent a few days getting through it, and then we burst through, and then we came down and we retested this level. So, you can fine tune these all day long. I think the bigger thing that you want to be aware of is when you're looking at a support and resistance line, what do you want to capture? And if you're trading a big long cycle, then you're more interested in this is the general zone of resistance, and you're not so much interested on the day-to-day fluctuations. Now, that's really easy to say until you're losing money every hour. And so as that happens, then what we want to do is we want to try and zoom in. And so in this case, I've got candles set up now. For my next chart here, what I've shown is I've put in a bar chart, and this prior one here, we'll just zoom in and save that as candlesticks, and then we can compare them. But the idea being, your candlesticks and your bar charts are going to show you the intraday closing lows and highs, whereas you don't get that, or intra-week closing lows and highs, whereas you don't get that with the line chart, right? You only get the end of day close. So we can draw this line in here now for copper and just say save that. And when we do that, if we go back and change it from candlesticks back to a line chart now, it might not line up with all these endpoints. They appear to be sticking down in space. And the reason for that is that's the intraday lows. Now, so somebody would say, well, do you use the low or the close? Well, it depends on what you want to use. And so the right answer is this line held all the way through here for intraday lows, but the other line, this line up here, held all the way through for closing lows. And so again, it's important. Do you want intraday lows, or do you want to wait until it actually closes below it on a day, and then that's your sell signal? So how do you want to trade it? In this case, it's a weekly chart. But the point I want to make is that the line goes where it fits best for your eye and your time frame on the chart. Now, on this one, I'm down to a weekly chart, line chart here. You could just gently see we have a downward sloping trend right now. So we're going to draw a line across the top here, and we're going to say, well, can copper break out above that line? And if it does, that might be worth owning. Okay, so that's the idea here, is to take it as a reference point. Now, we could do a whole bunch of things here. We could use horizontal support and resistance. We could use the lows down here at $4 and say, if it gets down to $4, I want to buy it, expecting a bounce back up. Or if it gets down to $4, I want to sell it because it's all going way down from there. Any way you want to trade with a line. But the purpose of the line is to show you a trend. And if the trend is being broken intraday, or the trend is being broken at the end of the day, you just really want to use a line chart or for end of day, and you can use candlesticks, or you can use bar charts for during the day. I think that's really a personal choice. I don't like candlesticks. I think they make me worry too much on a big red day, so I tend to not use them. Now, the other thing that happens is as time goes by, where the line is placed changes. And so originally on this particular chart, I had a line going in here marking the lows. And then that didn't look very good because it just kept stretching out past it. So then it's not uncommon that what you'll find is this point of resistance here where you go on your final flush actually becomes a point of contact. So either the point before or the point after you could use. Now, if we take that same point and just, if we take that same point and now start to swing this line around, we might swing it up here, and that worked until it broke. And then when it broke, that looked pretty severe. And now what we have is a line that, whatever we want. We could draw it all the way out to here, but the trend keeps changing, right? So we have a line that we could have here going through these lows and coming out here, and we could just say, okay, we're waiting for it to break that big long-term trend. Or there's a line in here that has like 10 touches, but it's for a shorter time frame. Only you can decide how long your time frame is. And we look down here at the bottom, we can draw some trend lines in here. I think this is a pretty important rule, right? You just draw your trend lines, then you get another trend line this way, and then you get another trend line this way, and that worked pretty good. And now we have a channel building sideways where the market is literally hovering sideways, and so we can just keep an eye on this sideways channel and see which way it's going. The idea of the line is not an absolute value. You can use it that way. You can say I want to get it 10 cents above the prior high or whatever, or you can use it to help establish the trend. You can also put the line right in the middle of the trend and just say that's the trend. So it's however you want to do it. You can then add a line below and add another line above and say this is my channel. I want to watch the price action move in. All of those are valid lines and nothing wrong with any of them. The biggest thing that you're trying to figure out is the trend changing. And so when a line breaks, typically that's what we say is the trend is changing. So try to use the trend line to help you with the trend analysis. And then if that starts to fail, and again, we had this trend line up in here, as it started to fall below that, that was a pretty big deal, right? All of a sudden we had, this was working, and then we start to break down. So we're wondering, is this market really going to start to crater? And it just happens to be lining up at the same point where we start to get some oscillations in our advanced decline percentage, and so we're starting to wonder. The important thing that we want to do is just be aware that something might be changing. And in this case, what's happened is we really don't have the same rate of advanced decline going on, and the market's been pausing. If we zoom in, we can see it's no longer getting up near this upper trend line. There's actually a lower trend that we could draw in here. So again, the purpose of the trend line is to help establish the trend. There is no right or wrong answer. The one thing I will say is that whenever you come off a major low, and let me just move that out of the way, whenever you come off the major low, there's going to be a trend break, right? So we had our original first thrust up, and it was like this, and then it went a little lower, and then it went a little lower, and then we start to think about analyzing it this way, and then you're moving trend lines all the time. They're not a static piece. But I think when you get a big trend line here with like 10 touches and all of a sudden that starts to break, that's a meaningful trend change that you want to be aware of. And we saw that back in 2020 when all of a sudden the whole thing broke down. So try and use the trend lines to help you. Some people say, I only use horizontal support and resistance. Cool. You're not analyzing the trend. You're looking for support and resistance. Totally different thing. Okay, so I think I've covered that off quite extensively, but it's an important thing to realize that if you only want to use closed, then use a line chart. If you want to use intraday, then put those lines on the bottom of the intraday trend and keep track of that. Now, the next thing I want to cover off is arithmetic scales. And the reason I want to cover that off is I saw a chart on Twitter the other day, and they're like, wow, this market's going ballistic, and this is set for the biggest sell-off ever. Well, what happens on an arithmetic scale is that when you have $100 and you make one more dollar, 101, that's a 1% gain. The problem is when you're at $1,000 and you want to make a 1% gain, now that's $10. Or conversely, if you're making 100% gain on 10,000, that takes you to 20,000. If you're making 100% gain on 100, that takes you to 200. So the arithmetic scale doesn't care. The log scale does. So the move on a log scale chart will show the same as the percentage change. So if it's a percentage change from 7,500 to 15,000, that will show the same as the percentage change from 125 to 250. So this distance will be the same on the chart. On an arithmetic chart, it doesn't care. It basically just says it one for one. So you can see how the scale compresses as you go up here, and you can see how these grid lines don't change on an arithmetic scale. The one thing that you want to be aware of is this is basically telling you the percentage gain is relatively normal. This is kind of the normal rate of travel that we've had for 10 years now. And in 2020 or in 2000, the market surged super quick. On an arithmetic scale, it looked super bad. It looked just like this because you didn't have the right-hand side of the scale. And then, yes, it came plummeting down. The problem is with that analysis is it could stay up here all day long. So just because something looks like a spike high, it's probably on an arithmetic scale, and it doesn't have to be. I've got an example in this presentation of different scales that you can use, but on AMC as an example, it was on an arithmetic scale or a log scale. It went ballistic. So those types of things are important to realize. Now, that was for an index. Now, for a regular stock, what happens here is my setting here is for arithmetic because the log box isn't clicked. So when I try to draw a straight trend line, it's not going to work. What happens is this thing keeps moving up faster, so I end up having trends like this. And I had a trend like this, and I had a flatter trend. So as the stock climbs, your trends are moving what we call parabolic. So it keeps getting steeper as it goes around the corner. If we have a line chart, so we're just going to do this, or if we have the log scale, then when we take this, what you might find out is that the log scale line works pretty good. And you can draw that across there. So that can also be a factor. So always check your scale. So if it's getting compressed on the right-hand side, it's a log scale. If it's not getting compressed, it's an arithmetic scale. Okay, one of the other things that happens on charts is that you can have dividends. And what happens is each time they pay a dividend, that's actually income you've got. So it's part of the total return from the stock. But what you do chart-wise is you actually reduce all the prior stock prices by the amount of the dividend. So let's say this is $62.35. If I put in the underscore symbol up here to see the actual hard prices, you'll see this has now changed to $67.13. The stock price has changed by the amount of the dividend, and that's just to calculate your total return. So it's not an error in the charting, it's a total return chart. And then if you don't want total return, then we do what we call unadjusted. Now, if a stock has a big split like Apple did, got to type Apple right. If you use an unadjusted chart for Apple, so here's a 4-to-1 split here. If you go back and look, you'll be able to see what prices were actually on the day you bought the stock, but you'll have this big gap. And so the stock was $515, and immediately after the 4-to-1, it was $125 a share. That's what a stock split does. It gives you 4 times as many shares at the lower price. So it takes whatever the closing price was and gives you the split. So the way to see that is with an underscore symbol here on the ticker, and that can help show that to you. Okay, the next thing that I want to show you is getting into moving averages. And people say, which moving average? And the right answer is all of these are moving averages. So I've got an 8, 13, 21, 34, 50, 65, 89, 100, 144, 150, 200 moving average on the chart. Now, what's your timeline for trading? Do you want to find this whole rip? Are you trying to find just anything that stays above the 8-day, and then if it goes back below the 8-day, you want to sell it? Lots of that kind of trading goes on, and so you really have to decide which trader you are. And the right answer is if you want to stay in a stock as long as it stays above the 200-day moving average, you're happy. If you want to trade above and below the 8-day moving average, now it went below, so you sell. Went above, you buy. Went below, you sell. Went above, you buy. Went below. Really depends on how often you want to trade in and out of the stock. And so when somebody says, what's the right moving averages? Some people will use the cross between the 8 and the 21 day, or the 8 and the 34, or the 21 and the 34, or the 13 and the 34. There's lots of different strategies, and all of them have the magic element to them that at some point you get a buy signal. You also at some point get a sell signal. The difference is how much room you're leaving for both. So if you told me that you're trading on a 5-minute chart, none of these lines are appropriate. You want your lines on the 5-minute chart. And then you want to tell me, are you above or below the 50 period moving average on the 5-minute chart, or the 20 period moving average? It really depends on how you want to trade. So it's not to put anybody off. The idea is which one of these do you want to use? And again, if you rewind the tape and shrink the data, what you see is you have these long periods of uptrends above the 200 and then below the 200 and then brief one above and back below. And, that's a big long-term trend. Now, what time frame you want is really up to you. So moving averages are based on the time period that you want to trade. If you want to make trades every couple of weeks, then you're going to use a shorter period moving average. If you want to make trades every year or every significant move up, then you're going to pick something like the 200. You're not going to get in early. You're not going to get out early. You're just going to get the big chunk of the move in the middle. Okay. Another approach is horizontal trend lines or fib lines. Fib lines are drawn by taking a point near the low and near the high. And you can see if I overlay them on a chart, the chart gets very busy. But one of the things a lot of people like to do is they look for convergence of a single point on a chart. And so it might be that in this case, the 150 period moving average and the 144 period moving average were very close to the 61.8 or the 38.2% fib line. So that convergence or that coincident factor where a lot of different traders are looking at the same level will come into play. To me, this chart's too busy, so I would either just go through and I would change all these opacities to 0, or I would clear all, right? And if I cleared them all, then I can just see the fib lines sitting there by themselves. So you have to decide what is the data and what is the data you want to see. So I went from the low to the high, and then what happens is you look for your retracement, and at the 38.2 and the 50 and the 61.8, you'll see the different levels of, you'll see that most of the price action is in the center of that band over time. So that's one of the reasons to be aware of fibs. Now, I'm not going to get into a whole fib lesson here, but there's a lot of people who use Fibonacci. So if you like Fibonacci, that's another method that you could use. The next idea is to have Keltner bands. And what you would do with a Keltner band is it basically captures the outside of the move. And this is the standard one in blue. And then I've put a narrower one in the middle. And what you can do is if it's below the Keltner band, you don't want to own it. If it closes above it, you want to own it. And then the next time it closes below, you want to sell it. Now, in this case, you would have got in roughly about here and you would have got out roughly about here. You didn't gain much. But, if you get a nice move like a Google chart or something like that, or even in here, this was a wonderful strategy all the way up. And then in February, it changed for this particular stock. Again, there's no right answer. It all depends on how volatile the stock is. You can use it to, if it touches the extreme, you want to sell. If it gets to the bottom, you want to buy. If it touches the extreme, you want to sell. There's a whole bunch of different methodologies around Keltner bands or Bollinger bands or moving average envelopes. You can use any of those to help facilitate starts, entries, and stops where you get in. If it gets up to it, that's an exit signal, or if it goes below and you had bought as it went above, so in this case it went above and here it went below, you'd be back out. And once it got back in the band, you'd try to buy it again. So it really comes down to your trading style, but I think the big thing to remember is whatever you're doing, whether it's a line, a Keltner band, a Bollinger band, it's something to shoot against. It's a target for either an entry or an exit, and I've just shown you a whole bunch of different ones. They're all valid. So now here is horizontal support and resistance lines, and I've just laid them on the chart. Basically, if this chart stays above the red line, I want to own it. If it falls below the red line, I want to sell it. Well, it closed right on the red line today. So the answer is, how do I want to handle this stock? If it starts to break down, I definitely don't want to own it. If it starts to bounce off here, then it's okay to own. And hopefully I'll get a move all the way to the other side of the channel. Or better yet, maybe I'll actually start to break out above it. But the only way you can enter the trade is by deciding what you're going to do at this point. Are you going to sell it because it's breaking down, or are you going to buy it because that support has held before and now you want to buy it? Lastly, here's a chandelier stop method, and basically if it goes above the chandelier stop line, you want to own it. And as price is surging up here, it's moving so fast it forces the chandelier exit to come riding up with it. And then the stock finally breaks down through it, so you're selling. And then all of this time, you don't want to own it. Now, this chart was very jerky. And again, I've got the arithmetic scale set. And if I go to log scale, that's going to change everything. It's going to look a little more normal. But this stock had two parabolic moves up. And now it's above your chandelier stop. Typically, this isn't used for a buy signal. It's used for a stop to get you out of the stock. But you can take this, and if I went for Google as an example, the chart is much smoother, and this would have kept you in the whole time. Now, if you think it's just a little too tight, you can change these settings, and you could basically say, I want, a 4% move off the highs. And so this is going to try and keep you in the stock longer, but again, now you're waiting for a 4% move down instead of a 3% move. So working with different trend lines on the charts, again, is there a magic answer? No, there's an answer for every person's trading style. And, I see some people on Twitter, this thing's above its 200-day moving average, and it's perfect. There's nothing wrong with the stock. It's great. It's still climbing. That's cool. That's their trading style. If your trading style is to stay above the 8-day and then sell, or you're on a 3-minute chart and you're using a 90-period moving average, cool. There is no right or wrong answer, and I think it's really important that people understand that. So as you look at charts, you have to decide how big a trend you want to capture, and the most important part of it all is that the idea behind having something to shoot against, just some sort of level of support that you think if the stock doesn't hold there, then what I thought was wrong, and it kicks you out. You're not going to be right on every one. So yes, the purpose of a stop is to kick you out when you're wrong. The idea of these trend lines, moving average lines, horizontal support and resistance, if a stock breaks out to a new all-time high. So let's go back and look at FCX briefly. When this stock, when you look historically, so we just draw a line out here, you can see the stock basically had a top at 1350. It got up here to 1381, paused, and then it finally started to move on its way up. Now, it was still shaky all the way up, but it moved higher. When you get these breakouts to new all-time highs, lots of people like them because everybody who owns the stock is happy because the stock is higher. That's the purpose of trying to use these horizontal lines or trend lines or whatever, is to figure out where your entry is going to be and why. And then if it doesn't work, where's my exit? And if you don't have a method, you can use 2 times the ATR or a chandelier stop, which is what I've got here. You can use Fibonacci ratios. You can use Keltner Bands, Bollinger Bands, whatever you would like. All of them are valid, and so when you read on Twitter that this signal worked and this is a sell and whatever, it's based on their system. And so try not to get too hung up on them. Try to get hung up on how often you want to trade. So with that, I want to say thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesday at 10:30 a.m. Eastern Time. You can also see the recording on StockCharts TV YouTube page. So in case you like this, keep track of it, and then you could come back to it at other times. StockCharts also has a StockCharts on demand. So thank you again. Have a great day. Bye-bye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.